Okay, let's bring in Chris Conway. He joins us now from Australian Stock Report live out of our Melbourne studio. Chris, good afternoon to you. Welcome into the program. How are you viewing the pullback? Is it the pullback that we had to have here on the Australian market?
Good afternoon, team. Good afternoon, Ingrid. Yeah, look, I think it is, to paraphrase Paul Keating, I think it is the pullback that we had to have, and that's just because of, as I've said before, how quickly we arrived at 61.50 off that April low. So, yeah, we all know markets don't move up and down in a straight line. 61.50 was the high. Really not surprising at all to see us pull back from that. And as I said to you last week, Ingrid, we really need a catalyst now to get back above that level. And sort of like Rudy, I can't see one coming. Maybe if the US gets going again, which, you know, is a possibility, then that could drag us over that level. But look, by the same token, I don't expect us to see us fall back, you know, really sharply either. I would hope that we would find some support around 6,000 and at the very least just sort of grind sideways for a period before that next catalyst arrives.
Yeah, catalyst, that's the question, right? I mean, and Rudy, you were saying, you know, you're not entirely sure of a catalyst, but what would you put out there as a catalyst for markets?
Well, I see negative catalysts.
Yeah.
I mean, it is.
And what are they? Just outline some of them for us.
You see it in Australia now as well. The economic data are underwhelming.
Yeah.
They either miss expectations or they just make it, but then the underlying data are weak. The same pattern is happening elsewhere in the world. So if economic data continue underwhelming, then there's no doubt that people at some stage will start looking at, like, listen, the US dollar is strengthening, oil is high, economic data slow down. That's not, and the Fed is still intent on tightening in the US. That's not a combination where you go like risk appetite is going to spike.
But I mean, Chris, when you look at the technicals of the market, I know you look at that and seeing us 120 points of our highs. You mentioned that you might see some opportunities at some point. What level would you be looking to maybe get back in?
Yeah, so 6,000 is the level, is the immediate level that everyone should be watching. And again, you know, I just want to see us not plunge through that. You know, if 6,000 gives way, we're probably looking at 57.50 before the next level of support arrives. So, you know, we really need to hold there. And don't get me wrong, I'm not saying we just bounce off that level and, you know, run straight back up to 64. But there needs to be some defence in here somewhere if this market is going to hold up. You know, we can't just give back everything that we gained in that, you know, that great run that we had where we had 17 out of 20 winning sessions. We can't give all that back up so easily because, yeah, that will decimate confidence. And, you know, those downside risks that Rudy's talking about will hang over the market.
We've seen the banks take a bit of a hit though, Chris, and usually when they take a bit of a hit, investors tend to get back into them pretty quick. There is somewhat a flaw for those banks, but also watching commodities which have been weakening a bit, in particular iron ore, oil's even coming off a bit now. If we see commodities bounce back and banks hit a level where investors are getting back in, surely that could be a positive catalyst for the market.
Yeah, I would think so. And the interesting thing about the rally from the April low up to 61.50 is the banks did nothing. The market was up 5 or 6%. The banks didn't participate at all. I think they were up 0.1% or some nominal amount that didn't make any difference. In terms of commodities, look, I'm still a commodities bull, particularly in oil. I think there's further upside there. We know that commodities markets overshoot in both directions, and I think there's still overshoot to happen on the upside with oil. And it's all about, you know, I know we use this phrase a lot on this show, is that synchronised global growth. It is happening. There will be weak data points along the way, both locally and indeed internationally. The other thing that I think would say could be a positive catalyst is I think the market will come to grips with these high yields in the US. You know, there's a lot of historical data that shows that money doesn't migrate away from bonds, the risk of equities and back into bonds until rates get up around sort of 4.5–5%. We're nowhere near there yet. So I think, and history would show, that there is the possibility that as yields are going up, markets can continue to run higher as well.
Chris, Rudy, I have to jump into this one. The levels you are quoting for bond yields, that's correct. But that was then, and this is now. Of course, we are in a different environment. If I would strongly advise everyone to have a health check if they think that bonds are going back to 5% anytime soon here.
Yeah, so look, I take your point, and look, again, I'm just pointing to the historical data. So I think it's since about 1960, there's been 11 periods where rates in the US have been or yields in the US have gone up, and equities have risen in unison until about a 4.5–5% level. So I know we're starting from a lower base this time, but that's 11 out of 11. It's 100% strike rate. Could it be different this time? Absolutely it could. I guess you're putting more weight on that it's different. I'm putting slightly more weight on the fact that we've seen this movie before, and if it happens gradually I don't think it needs to derail markets like everyone thinks it will. If it happens rapidly, I completely cede the point, and I'm in your camp that, yeah, it will upset the apple cart.
All right, we'll watch this space. Chris, moving on to some company news, we're watching Aristocrat Leisure out with its half-year numbers. Of course, investors loving it, 7% bidding it up today, sitting at $29.69. Question is, going forward, do you see upside from here? Are you buying in at these levels today?
Probably wouldn't today on the back of a 7% jump, but this is a stock that I've liked over the journey. You know, obviously I'm a trader, so I'm not a long-term holder, but I have traded it with success over the journey. And look, I love this company. When you look at numbers like NPAT growth of 25% and revenue growth around 34%, that's super, super impressive. The bigger number that stood out to me, I have to refer to my cheat sheet here, it was about a 500% growth in the users of their digital platforms. Now that is huge. Now I know they acquired Plarium and Big Fish, so that's contributed to that big number, but that is a massive surge in just user engagement, which they'll be able to monetize. And a big part of the reason why we've seen strong results today, and I think they can continue to grow into the future.
What do you think, Rudy? I mean, and where do the sort of analysts sit, the research side sit on Aristocrat?
Well, there's a few very solid expectations I can definitely make. One first is I am a shareholder and I've been for quite a while. And the obvious point to make here is that while a lot of people try to make money out of beaten down stocks, the Telstras, the banks, I'm on the stronger side, and I pick very strong growth stocks. And this is one of the prime growth stories in the Australian share market. I've been saying for a while the stock is poised for $30. I think it's but a matter of time the share price will overtake BHP and Woodside in nominal numbers. The analysts, the bullish ones, are now beyond $30. So I'm assuming, taking the leaf out of the booklet that happened to Macquarie only a few weeks ago, I think we're now going to see mid-30s, if not high 30s.
Yeah, because it's sitting, I mean, it got to $30.25 today, so I'm sure it would have maybe surpassed or at least reached a lot of analyst expectations. Do you think we'll actually see them go as far as to upgrade?
It hasn't beaten expectations, it has blown away expectations. So yes.
So we'll see analyst upgrades off the back of this?
Absolutely.
So, I mean, Chris, with that in mind, what catalysts are you watching for Aristocrat going forward in terms of it being a growth stock?
As I said, it's probably a bit more about the digital space and that number that I pointed to of 500% growth in users. Again, I hate to repeat myself, but that is a huge number. And, you know, they have been very good at taking these acquisitions, Plarium, Big Fish, integrating them and then, you know, developing those opportunities and extracting more dollars out of them. So, you know, Aristocrat has a really, really strong track record of doing this, of taking these acquisitions and growing them exponentially, and that would be my primary, you know, growth engine for Aristocrat.
Okay, moving on from that, and I know you're also looking at the lithium space at the moment, Chris, as are a lot after that Kibben Resources deal, but there's a lot of talk with Elon Musk also building the lithium-ion batteries. There's talk, I guess, about this space for a while, and there's been a lot of love for this space over the last couple of years, so I just wonder how much wriggle room there still is in these stocks. I mean, do you still see a lot of value?
Look, a lot of opportunity. It might be speculative opportunity, but yeah, I think just because of the growth. So looking at some of the numbers from 2015 out to 2020, we're already on track for the size of the market to double from about 170,000 tonnes per annum to 340. And then from 2020 out to 2025, it almost is expected to double again out to 600,000 tonnes per annum. So yeah, we think, you know, obviously it's a growing space. Obviously competition is heating up. Anytime, you know, there's a honeypot, bees will come to it. And that's what we've seen here. But a couple of names that we like in the space. Dempsey Minerals is one. They've got a project over in Argentina in the Hombres Muerto, forgive my pronunciation, region, which is sort of the biggest lithium basins in the world. Really strong management team, more speculative because, you know, it isn't only an explorer, but the share price has jumped from about 5 cents to 17 cents over the last, since August. So there's one we like there. But the key with all these companies is to try and get an offtake agreement. So one of the big things that's been happening in this market is, say, car companies and people that want the lithium have been doing an end run around the traditional ways of securing that production and going straight to the miners. And Altura Mining is a company that's managed to do this. They've teamed up with a Chinese battery maker that runs about 20% of the Chinese battery market called Optimum Nano, and they're willing to buy 100,000 tonnes of production each year for the next 5 years. So there's a couple of names in that space that we like.
Just want to bring viewers across some breaking news, which of course we already knew was happening, but as a formality, Frank Lowy has officially now retired and stepped off the stage as chairman of Westfield, of course, after Unibail Rodamco. That deal was voted through by shareholders. I guess, you know, Rudy, we already knew that he was going to retire. This is a formality, but it's a big deal, you know, seeing Frank Lowy leave and seeing Westfield not as we know it.
It definitely is, and I have been pointing out ever since the announcement that people should think twice, if not 3 times, about their exposure in their portfolios to this sector.
Well, yeah.
The Lowys are not selling for nothing.
Yeah, and it's true because we know they had perfect succession plans in place if they wanted to stay in the sector. You know, there's a big family, so
very good reason why they're selling.
Yeah. So in terms of others in the market that are similar to this, Rudy, what sort of exposure would you be reducing?
None.
Where would you be reducing your exposure? What stocks can we sort of look at as?
All the shopping mall owners, vicinity centres, etc. Centre. Don't go there.
I mean, Chris, would you agree with that? End of an era with Frank Lowy stepping down, as we knew this would happen, but the formalities obviously just happened at the AGM, so that's something, you know, to keep in mind. It's been a big part of the Australian market, and Frank Lowy's certainly been a big part of the Australian corporate scene. But, you know, do you agree with Rudy in that seeing, you know, Frank Lowy step away from this, the Lowys in general, you know, sell off Westfield, you've got to ask the question of the future of these retail centres?
I agree with Rudy 100%, absolutely. You know, who would have better knowledge of the industry than the guy who's built the biggest, you know, the biggest empire in the space? Obviously, the question answers itself, and I agree. For him to be stepping away, it sends a pretty clear signal. Look, I don't have any holdings in that space, and I don't tend to trade or play in that space, but yeah, in terms of the question at hand, I absolutely agree with Rudy that, yeah, it's a very strong signal, and if you're holding these stocks, you should have a serious look at why you might continue to hold them or whether you sell them.
Yeah, all right.
Chris, I'm disappointed. What happened to the conviction? 110. 110.
The maximum I can give Rudy is 100%, mate. I'm sorry.
Yeah, he's there. Conviction there. Chris Conway, we'll leave it there with you, but appreciate your time on the program. As always, thank you.
Thanks, guys. Cheers.